Stocktake is brought to you by Intelligent Investor, Australia's leading value investing research house. Get your free trial by heading to intelligentinvestor.com.au. The information in this podcast is current on the day of recording. It is general advice only, does not take your personal situation into account, and may not be suitable for you.
Good morning, everybody. My name's John Addis. I'm the founder of Intelligent Investor, and we have a special guest here today. I'm not saying that Canadian Graham is not special, but he's normally here, and he's here again today. But we also have portfolio manager Nathan Bell. Nathan, how are you doing?
I'm good, thank you, mate.
Oh, yeah? That's good to hear. Now, we are expecting a rave about the ridiculous prices on the banks, so prepare yourselves for that. But I do want to read out some price changes over the past month or so, because I think it gives us some context for what we're about to talk about today, which is Woolworths versus CSL, followed by some commentary from Nathan on our portfolio changes, which will give listeners some context to the kind of opportunities that we're finding, the things that we find terrifying right now. Okay, let's start with Tabcorp, up 21% in February. Ramsay Healthcare, up 18.5%. Commonwealth Bank up 17%, Woolworths up 16%, and BHP up 15%, NAB up 13%. All these blue chips are flying, Nath. Can you tell us what on earth, well, supposed blue chips, what on earth is going on? We don't normally see moves like this in this kind of market.
I think that would be at least an hour or two conversation. So I'm going to just try and focus on, I think, a couple of the main things that are going on. And the number one thing I would say is this is not your grandfather's stock market anymore. The way the market's operating now, and again, it's always just guesswork because our fundamental framework hasn't really changed, but the way the market's operating has certainly changed. And I think there's a couple of things. One, there's this sort of lack of active managers in the market now on the whole, and retail and super funds and ETFs and index funds and all the rest of it are really what dominates the market. But you've also got a lot of short-term trading strategies, not just from Australian-based investors, but from overseas investors as well. So you're seeing these massive short-term moves in stock prices on a daily basis, and particularly around results, that you might sit there and argue on fundamentals aren't deserved, but that's to miss the point, because the trading actually going on is not fundamental investors. It's just everybody else that's moving their money around. So you get, for example, a result comes out, you've got all the algorithms or the bots or whatever you want to call them set up with these sophisticated algorithms that are ready to go. They look for whatever words they're looking for in a transcript or a result, or certain numbers in the result, or whatever they can do, and it's lightning quick. There's just no way you as an individual can try and capture that trade. But these guys are all sitting there, and before you know it, the share price has reacted by 10, 15%. And then on top of that, if these are big blue chips, then you've got all these ETFs and index funds that need to rebalance into these stocks. And so then they accentuate the buying and selling. So that's sort of the crazy atmosphere you're living with on a daily basis at the moment. But I think the other thing too that's probably just given the blue chips a little bit of a kick just in the last month or so is that the results of some of the big stocks like the banks were actually better than anyone was thinking. I mean, basically everyone had penciled in virtually no earnings growth for the banks, and they actually managed to do sort of 3, 4, 5, 6% earnings growth, which if the stock's trading on 25 or 27 times earnings, if it was any other growth stock, it'd be taken out to the woodshed and shot. But for CBA, that's just fine. So the stock goes up. And that's what it's frustrating at the moment for our portfolios, because I would have thought after reporting season, our funds should be up 10%, not down 10%. And then the index, which is basically made up of CBA, BHP and the other banks, is up 4% or, sort of 8% in a couple of months. And that's what you get compared against. And obviously we're long-term investors, but, after we really rebuild our track record after a few years in the doldrums where our stocks were just out of favour, it lasted a few months, and then here we are 7 weeks later, and it feels like we're back in the same spot. And you just go, our companies are doing great. This doesn't make sense, but it's just a different stock market to what it used to be.
Yeah. Graham, do you want to add to that? Is this your grandfather's stock market? Is your grandfather different to Denise.
My grandfather was the guy who put his money in the bank and watched it depreciate as inflation chipped away at it. He was not a stock investor.
You sure I'm not his grandchild?
He sounds like my grandfather. Yeah.
No, in terms of the stock movements, I think Nath put it pretty well. It was a case where the ones that were going up were just beating people's expectations. I think the current market had put in a lot of negativity to some of those stocks, and even just a slight beat seemed to send them up, even with CBA.
Yeah.
The thing is, I think what's hard to grapple with is there's no consistency across the board. So, John, for example, you named all those stocks that went up, and yet Wesfarmers' result, for example, wasn't too bad. And even though it trades on a huge premium like all those other stocks you mentioned, its stock price has gone down.
Yeah.
And, because I think people are starting to think maybe retail is not a good area to be in for the next, 3 weeks.
Yep.
And
Helios down 24% in February.
Helios is the biggest surprise to me of all. Yeah, its result, yeah.
Pro Medicus is down 30%. WiseTech's down 18%.
Like, to me, let's just say, for sake of argument, you agreed with, what seemingly has pushed Wesfarmers' price down, is that retail is not a good spot to be. Well, what is that informed by? Is it, must have something to do with higher interest rates or mortgages going up and more repayments and, something wrong with the consumer, right?
Mm.
Well, why are the banks going up? It's just whatever sort of general theme you can sort of pull out that might explain the share price movement for one stock just doesn't track with another industry.
I mean, when you read out that list, it does seem as though the enthusiasm for tech stocks has gone into what you might call the staples of the ASX over the past 10 or 20 years. But like you say, it's a very, very strange market to invest in, which brings us to our first big topic, which is Woolworths versus CSL. Now, Woolworths has had a big price move. It's kind of in the midst of a turnaround, or I hope it is, because I should disclose I'm a shareholder in Woolies. CSL is, I think, probably you would call it a turnaround stock now.
It's certainly trying to be.
It's trying to be. It's down 50% over the past two years.
So we'll say it's failing to be.
It's failing right now.
Well, that's the first step.
Yeah. So let's dig into these stocks first, Graham. Maybe if you can just start talking about. We did a deep dive on CSL where we spent an hour talking about this business, and I think the price then was at around $200. When was it about $220 when we got it on the buy list?
Yeah,
like
it must have been around there.
Yeah, and now it's down to 150. So let's start with CSL. Why has it fallen from 300 down to 150, and what's going on?
Well, to some extent, I think both of them have suffered from the same problem in very different ways, where they made some poor acquisitions, poor kind of strategic decisions. An acquisition in CSL's case when it bought Vifor, and Woolworths pushed into the Masters home improvement stores, which essentially blew up a bunch of capital for shareholders. And then both of them have at the same time been suffering from their margins being squeezed for different reasons. And so they've kind of had to deal with two problems at once over the same kind of period, where they're dealing with these strategic miscalculations, and then at the same time dealing with all these other pressures on their business that are causing margin issues. So in CSL's case, it's probably the one that I think it's probably got the most upside from here in terms of both of its profitability, and then also the prices building in a lot more negativity. So the issue that it's had has been the purchase of Vifor, which it really did overpay. At the time, they had some, I think, reasonable rationales for buying it. They were very reliant on their plasma business, and so wanted to diversify a bit into iron deficiency therapies. So on the face of it, that seems sensible enough. And Vifor, in terms of its actual assets, is pretty good. It earns, I think, 100% on tangible equity or so, or tangible capital. So it was a good asset. The issue is that they paid an astronomical price for it. And so CSL's overall return on equity has come down from in the high 40s, which was a really strong number for any business. And now it's down to a more, still above average, but a more kind of reasonable 15 to 18% or so. And But the other issue hitting CSL was during the pandemic, it pushed up a lot of its a lot of its costs in collecting plasma, where people weren't able to go to the clinics to actually donate. So then that led to all of these issues in collections. CSL also has a very long manufacturing process. It takes a couple of years from a needle in the arm to a product on the shelf. So it's always kind of a slow recovery for it. And the other issue since then has been, well, even more recently, some immigration issues in the US, where a lot of CSL's collection has been along the borders, or at least the Mexican border, because they benefit from people crossing the border to donate to get their $30 a week of donation fees. You can't donate for money in Australia, but in the US you can. And so that's why a lot of their collection is done over there. So anyway, yeah, CSL's it's mainly been a cost problem. They haven't had any real issues on the revenue side until maybe this result a little bit, where they've thankfully been in quite an industry where there's a lot of growing demand for immune therapies and plasma therapies. So yeah, the issue has been mainly around their costs just getting out of hand with labor costs, and then also the collection center costs, and then the fee payments had to go up because there was issues with competition for the diminishing donors, and yeah, so a few different things. But that also means that they're probably, you'd say, under earning at the moment, where their margin is down about 5% gross margin since just before the pandemic. And they have been slowly chipping away at that by improving different aspects of their business to make it more efficient, particularly the collection side. So the idea is that they can eventually boost collection volumes, boost the yields out of those volumes, which means that then they have cheaper inputs for the therapies. The therapies themselves aren't really under too much pricing pressure, and a lot of them are very specialized, where they might be the only operator selling that particular niche therapy for the rare disease that they're targeting. Some of their therapies are targeting just 10,000 people. It's a very niche business. It's not like they're making cholesterol pills or something like that. So on the whole, I think that they are chipping away at improving their margin again. They made a huge mistake in purchasing Vifor, but they've now changed management and hopefully won't make, they'll make new interesting mistakes, but they won't make the same mistake. So that's behind them. And yeah, now and you're getting it at 20 times earnings at the moment, which for a business that has underlying demand growing at kind of 8%, they've historically raised prices by 2 to 5% a year. Yeah. And they're improving their costs at the same time. Like this doesn't seem like an unreasonable stock, though they've made some big mistakes over the past 5 and even 10 years that landed them in this position.
And they've got new management in recognition of those failures over the last decade. The new management's been installed, which is kind of old management, really, isn't it?
It is, but the new guy used to run the vaccine division, and he turned that around pretty well. They haven't got a permanent CEO, which was a bit disappointing. The current Gordon Naylor is just in temporarily, but they'll find someone and hopefully offer him the job. He didn't seem to rule it out in his initial comments, so we'll see.
Okay, so Nath, before I let Graham get back to Woolies, just this question on this, like companies like CSL, Reese, WiseTech, Zero. We've had all of these so-called blue chip companies that over the years has been on our high quality, like best businesses in Australia, and they go through these periods where their position of dominance, their management capability is undermined in some way. Either it's self-inflicted or there's new competitive threats. What does that tell the average investor about their investing environment? It doesn't seem as though you can really buy and hold like you used to. All of those stocks that you thought you can just put away and it'll just tick away in silence and there won't be any problems, that just doesn't seem to happen anymore.
No, I think there's a bunch of things here, and I think CSL is a good example that it had an incredible magic trick for probably a decade where it made a really difficult industry seem really easy. I remember reading an article back in the old days when I covered CSL, And it was with Brian McNamee talking about how they go about investing in new products with his chief scientist. And it said that they invest for 10 years and they don't know what the outcome is going to be. Now, if you think of that as sort of like CapEx, if the R&D is like a big capital expenditure program, the difference is if you're an infrastructure stock, you know, particularly if you're regulated, you know pretty much exactly what your return on that CapEx is going to be. And obviously that's the big question with the big tech stocks in the US at the moment, is no one really knows what the returns on these data centers are going to be, hence why there's so much talked about them. Now with CSL, like they have no idea what those returns on they don't even know if they're going to have a product at the end of it. Like they make the investment and they do all the work and it can be over decades and they don't even know if they're going to have a product at the end of it. But what they did was they just went through a great period where not only did they have good results from their R&D program, but they just built this international, particularly US global blood business, which is sort of more about just collecting and disseminating blood products, which is just a bit more sort of like a glorified manufacturer than necessarily coming out with all the greatest products, although they were doing that at the same time. And because the growth in the industry was so big and they just dominated and turned this small franchise into a global scale business, you know, it was just a Lollapalooza effect for the earnings. And I think people just forgot that actually any business that involves R&D for its future revenue growth is a risky business. And what the acquisition of Vifor told you was that if you're inside the business, you're going to see the future risk to your earnings growth before anybody else. And that's what these acquisitions tell me, is that people on the inside are going, our growth is going to fall here for, you know, whatever the reason happens to be. Companies are approaching maturity faster than they expected, or maybe they can see a customer's going to leave, or maybe technology is changing. Like whatever it is, the people on the inside of the business are probably going to see it before anyone else. And their instant reaction seems to be that, well, they're flush with cash because they've been these sensational businesses for such a long time. They're dominant businesses, and they go and make an acquisition. And that's really the first red flag that management is actually seeing a problem. And they think they can fix it with an acquisition, which, you know, I don't know what the statistics are, but I'd say is it 95, 99, I don't know, percent of times that the acquisition makes things far worse. But I think the focus when a company announces an acquisition is all the focus is on the price paid. Is it a good business? How's it going to fit in? What are the cost savings and all that sort of stuff? And they don't really ask the question of why. Why are they buying this? Why has WiseTech gone into debt to buy this really ugly duckling business? Why is Xero, when seemingly it's got the whole US to take market share from? It's the big growth engine. It's where everybody's being incentivized with these enormous pay increases and potential remuneration increases. That's why the CEO now resides in America, and so does a bunch of staff that she's brought in. You know, why is it that they all of a sudden need to make this acquisition? And the answer is the growth that everybody in the market is seeing and is priced into the stock is not coming. You know, management's fearing it's not going to come, so they try to bail themselves out with the acquisition. And that's why these seemingly unstoppable businesses all of a sudden hit a brick wall and they're all down, sort of 50 to 70% within the blink of an eye.
Now, that brings us to the issue of maturity, because this is something that every business faces. And as investors, I think we're often slow to face it. I'd say that's the case with Xero now, and that's why you're exactly right. That's why management have done this Melio acquisition. What about Woolies, Graham? I mean, they have this lovely GC duopoly. Woolies has been well behind Coles over the past few years, but they've got 1,500 odd stores. They control a big chunk of the grocery market. The share price is flying. Is this another turnaround that is turning around?
I definitely think so. I think there's a case that CSL doesn't. There are more risks to CSL's recovery than Woolworths, I think. Woolworths is a very big ship that is clearly turning around, and I think it has been taking the right strategic approach. So you've got to kind of juggle two things at once in your mind with Woolworths, which is that margins are permanently lower than they were 5, 7, 10 years ago. It's not going back to the 8% EBIT margin that it had back then, because Coles and Aldi in particular, and Costco to an extent, have come in and they have changed the market dynamic around pricing, where they've had to switch to this everyday low pricing strategy. Woolworths has been very late to that, and that's why it's been losing market share until just this kind of result, actually, this most recent one. But it's taken 2 years. It's been lowering its prices. It's put in more than $1 billion into the business in terms of cutting prices. And that does seem to be changing customer behavior a little bit and bringing them back to Woolworths because, they kind of dropped the ball after the Masters endeavor. They were so distracted by that, they really didn't
do anything.
They just focused on that instead of recognizing that Aldi and these other competitors were chipping away at their core business. And so not only did they blow the $3 billion on Masters or whatever it was, but they kind of lost their edge in the main breadwinner for them. But at the moment, management seem to be taking the right approach where they're going pretty aggressively on cutting costs throughout the business. Absolutely everything is under the microscope. And they're recycling those cost cuts into price decreases quarter after quarter. This will be the 9th quarter coming up that they're going to do that. And people are very price conscious at the moment in terms of groceries. And I think you're already starting to see the volumes flow back to Woolworths. And I think that can gain speed as that trust is rebuilt. So Woolworths is a fantastic business. It has the scale, an unmatched scale across groceries in Australia. It has a lot of competitive advantages because of Australia has a very low population density. And so it needs, it pushes towards a duopoly structure for groceries. So there's nothing that is going to dislodge Woolworths from that position. And it seems to be doing the right things.
So we've got a buy price of below $25. It's a long way from that. It's a hold up to $45, Graham. And it's currently at around $36.50. You've got a forward PE of 27. Like, how high can this PE go? Is it going to be another Wesfarmers? Is it going to hit 40?
Well, I mean, they can keep growing if they keep doing the cost cuts and then you see a sudden change in volumes flowing back to them. It can grow at a decent clip for at least a few years. I mean, over the long term, it's not going to grow much more than inflation and population growth. So you're probably looking at the mid single digits. But in the short term, sure, it can make that PE a lot better.
Okay. Well, those two stocks give some kind of context for our final topic, which is some portfolio changes that Nathan's made in four of our portfolios. Are you going to just talk about the income or the growth portfolio, Nath, or are you going to talk about some of the funds?
No, it's more just the general, just the fact I think this is a time for a bit of action to be taken for the first time in a while rather than necessarily all the individual stocks.
Mm-hmm. Okay, go on then, make your case.
So what's interesting at the moment is the indexes, if we just focus on the US and Australia, which are the two main markets we think about, the indexes are still at their highs. But what's actually happened underneath is there's been some absolute carnage amongst the higher growth stocks. In fact, like some of the share price falls are beyond 50%. Not necessarily the ones we own, but just in particularly in the software sector, which is not an area we've had any exposure to, and we've only still got basically one direct software stock, which is Constellation Software, which is sort of the Berkshire Hathaway of software. Won't go into the details; you can read it on the website. But so we've actually been really disciplined and haven't owned any of these highly priced stocks. So we haven't had stocks that have been blowing up on us, like the WiseTechs or the Zeros or any other growth stocks you care to mention. The only one we've had is CSL, which is a hedge position, so it actually doesn't hurt our funds, compared to the index. But if you have a look at the performance of the model portfolios over the last 2 months, particularly because of their overseas exposure, they're down, about 10%, while the index, either the US index or the Australian index, whatever you want to compare it to, is flat or slightly up. And if you just, there's a bunch of things going on here. So I think there's just a general fall in the valuations of what have been some very, very overvalued stocks for a long time. And also a lot of that sort of hot money, if you want to call it that, has been escaping from the WiseTechs and the Zeros and whatnot. There's also the SaaS apocalypse going on, which is, are software businesses going to be as good a businesses in the future as if they have been for the last decade? The answer is obviously no, but there will be some winners out of it. Yeah. And then on top of that, I think that SaaS apocalypse idea actually just spread more broadly to growth stocks. And basically any modern capital light business that happens to create value from a database. And that's just all types of businesses that don't have time to go through all into today. But so what you've had is, if we just look at the Australian market, which is sort of a good sort of dichotomy of what's going on, is you've had money coming out of the WiseTechs and the Zeros, even Technology One, even though it still trades at like 10 or 11 times revenue, it's still down from, I think it was like $40 or something like that, down to 25. And then all the money's going, well, the money's got to go somewhere. So where can I go where I feel like it's not going to go down? And that's the banks, because it's probably not going to be a massive profit surprise, but it's just a place where the money goes to and feels safe from a profit downgrade. And I imagine there's a lot of overseas money that's in the banks as well too, because I reckon that there's a lot of people feeling like the US dollar is going to go down, and Australia is also considered the safest market in Asia. So if there's always a flight to quality and money just wants to hide out, then Australia is usually a high yield, protected country with good rule of law and regulatory protections that serves that purpose for a whole bunch of types of investors, whether it's short-term hedge funds, people that normally put money in Singapore or China or everywhere just looking for a safe place for a couple of weeks, or whether maybe it's some overseas investors looking to get out of the US market, spread the money around and hopefully pick up a better yield, because even though I think the yield for the index at the moment is only about 3%, which is basically the lowest it's ever been. But that's still higher than virtually every other market out there. And if you manage to pick up 5 or 10% on the currency, and maybe even get some capital gains on the banks as well, like all of a sudden your return over 6 to 12 months, if you get all the timing right, actually is pretty good. So you've got all these different types of investors and speculators that are actually involved in these stocks. But my point is, I do think this is, like, to me, the banks are obviously overvalued as a group. I just think that's so obvious. If you compare their return on equities to the growth rates and their earnings, like it just looks absurd to me. But the banks as a group right now are the most expensive, I believe, that they've ever been. So yes, CBA is only at 175 and not 190, but over the last 3 to 6 months, all the money that was sort of pushing CBA to 190 or whatever it got to has actually gone into NAB. So the actual amount of money in the banks as a total has actually pushed that group up to the highest valuations of all time, which they normally trade at sort of on average 13 times earnings, and at the moment they're 20. And to me, the prospects for the banks are the worst they've ever been. The idea that somehow to escape the threat of AI is to go into a bank, to me, is just laughable.
It's a bit weird, because if you were thinking about who might be impacted by AI, you'd think that a banking system that runs on 1980s technology, would be one of your prime targets. They're going to find it absolutely impossible to try and respond to that threat, given the sort of legacy code base that they've got. Yeah, and as you say, going about Macquarie.
And Macquarie's already stealing their market share, and it doesn't need AI. All it needed was a banking license. It's got a pool of capital there of deposits, which not many other people have, but you can assemble that if you put enough money together. And it's got it's got cheaper technology, so it can offer better rates. So Macquarie's already chipped away, and this has got nothing to do with AI. And again, I talked about before how AI is essentially sending the share prices down of any business that relies on a unique and valuable database that can't be replicated. Well, if that's not the banks, I don't know what is. So that to me seems a really obviously silly place to invest to hide from AI. And I actually don't think a lot of individuals are doing that. That's not what I think a lot of Australians are actually selling their banks. They realise just how ridiculous the valuations are and how this is likely to be a one-off. And you only have to look at the share prices of the companies we've talked about today, whether it's CSL and the tech stocks. These were just stocks that just never seem to stop going up. And then all of a sudden something happens, the market changes its mind, and all of a sudden it's the old analogy of up by the escalator and down by the elevator. Right. So we know that's coming. And like you only have to go and look at the index performance between 2007 and to 2017 to go and have a look what we're in store for. It's like you don't have to be an experienced investor. It was the market over that period. There was zero capital gains for, I think it was 11 years. And all you got was the dividend yield of the index, which was actually not too bad because it was 5% or abouts, maybe 4.5%. And then you got your franking credits on top of that. The problem is this time is the starting dividend yield is 3%, and the valuations are even higher, which is essentially what the yield's telling you. The banks can't increase their payout ratios any more than they're already doing, and they've got more competition than ever. They're not going to get another decade of zero interest rates to fuel credit growth, and the iron ore miners aren't going to get another China coming along and growing at crazy numbers for 20, 25 years to boost their earnings. So the outlook is even worse. The valuations are even higher. The yield's even lower. So this, if an index or if you're going to own a portfolio of these companies, you should be thinking mathematically that if you can earn 3 to 4% and maybe some franking credits on top of that over the next decade, you're actually going to be doing all right.
It's all right, yeah. So whereabouts are you finding some opportunities in these? Like,
that's
what
right.
sectors do you think?
So that's the question. So what should you do if you do actually want to be active about your portfolio and you're not happy with earning 3 or 4% at best? Well, I think the one thing is there are a whole bunch of quality stocks that are trading way, way off their high valuations. And the first thing you need to know is that they shouldn't have got to those prices in the first place. Like REA Group shouldn't have been trading at nearly $300. Like that was just a silly valuation. But now if you look a year or two out, REA Group's valuation is the same as CBA's. And I never thought I'd say that as a sentence.
That's crazy, isn't it?
But the thing is, and that's just sort of a good example of what's going on more broadly. But if you're able to invest some of your portfolio internationally, I think there's even better value. You can buy Visa and MasterCard, which have every right to claim themselves as the best businesses on the planet. And you can buy them a year or two out at 20 times earnings, which is just crazy on what we know today. Now, the number one thing is we need to not ignore AI and not ignore the risks out there for these businesses. So I don't think this is a GFC type situation where it's just, this is a layup, it's time to swing the bat. We're still in, some sort of peak cycle. And, I don't know how long it's going to go on for, but we're starting to see a few little cracks in the lending space and private credit and things like that. Asset prices are still generally very high, but I think if you can do 8 to 10 or maybe even 12% with a portfolio of things like Constellation Software and Visa and MasterCard, and yet over 4 or 5 years, you actually potentially double your money on some of these stocks. Even Austbrokers and Steadfast, which we're going to be publishing an article about very shortly in Australia, that their share prices have come right down in the last just few weeks to now. They might even be trading on 12 times earnings looking a year or two out, paying 4 to 5% dividend yields. So,
all right, Nathan, I'm going to stop you there, mate, because we can't be giving away this kind of stuff. It's too valuable.
So the main point I want to make, though, is there are things to do, but they're not comfortable. They're not sort of layups that they're going to give you everything you want. They're just not the perfect blue chip, necessarily AI defensive. You've actually got to think through this stuff. Think about your portfolio allocation to these stocks. Think about how much in total. Think about the sort of businesses that are somewhat vulnerable to AI, maybe not in the next few years, but maybe, 7 or 8, 10 years out. Because I think a lot of these businesses have been sold down are far more defensible and far harder to crack than what the market's making out. But to me, I just want to provide a local example of just how the expectations for some actually good businesses have changed in a matter of weeks. And just how the story for these stocks has changed. I mean, AUB had a takeover offer that I don't think was very real, but it was at 45, and now the stock's at 25. Like, that's just happened in a blink of an eye. So that's really what I'm trying to say, is just that there are things to do at the moment, and I think you don't necessarily want to go and sell everything and dump all your money into all these opportunities, but I think you should certainly be selling what's expensive and leaning into these stocks, because I just think there are clear stocks that we're starting to reduce in the model portfolios that have held up well for us. And they're the stocks that we actually should be starting to liquidate to put into these other stocks now that are actually quite hated by the market, and where we think you actually might be able to double your money through a combination of capital gains and fully franked dividends, or mostly franked dividends over the next 3 or 4 years.
All right. Well, I think we're going to end it there, not just because Graham needs to go and have dinner with his returning partner, because I think it's about, what is it, 6:30 over there in Canada right now?
5.
Is it? Okay. All right. Well, you better go and put the stove on then, Graham, because you're the one who's going to be doing the cooking tonight. So thanks for your time, Graham. And Nath, thank you very much for your comments. It's nice to have you on the podcast. We should do it more often. We will see you again in 2 weeks. And if you are interested in all our reporting season coverage and some of the upgrades that we've made over the past few weeks, please go to intelligentinvestor.com.au for a free trial. And we'll see you in 2 weeks.